Welcome to another episode of the Doctors Building Wealth podcast. Kenji and I were going to call this podcast something like, when should you 1031 exchange? But the truth is, you pretty much should always 1031 exchange. And so today we're going to be talking about everything 1031 exchanging. We'll be talking about what it is. We'll be talking about what things you need to consider when you are doing a 1031 exchange. And we'll, of course, build in some real life examples from our own portfolio, from what we've seen in the community, so that if you're thinking about selling a property and you're thinking about 1031 exchanging, that you walk away with this episode with a lot more knowledge of what you need to consider, what you need to do through the 1031 exchange process.
So let's start out by talking about what is a 1031 exchange. So 1031 exchange is a way to take a investment property and sell it, take all that equity that's built up in that property, put it into another investment property, tax deferred. And what's beautiful about that is that it's like the money growing in your 401k. It's not taxed as it's growing, it's only taxed when you take it out. And so with 1031 exchanges, as you're trading up properties one for another, you're not paying any capital gains during that entire time until you sell that last property.
Yeah, so the alternative to a 1031 is if you sell a property and you pay taxes. And this can be even more painful to pay those taxes if you've taken bonus depreciation earlier on, because you're going to have a lot more taxes to pay because of depreciation recapture, as well as if you've had market appreciation or maybe you've built up equity in that property, you're going to have a lot more taxes to pay. Now, we have this awesome slide that we sometimes show in our presentation, and it shows what happens to a dollar if it doubles every year without you paying taxes over 20 years versus if you paid 33% taxes along the way. And you end up with $28,000 if it doubles and you pay 33% taxes along the way versus over $1 million if you defer your taxes. And that's what we're talking about here is actually, as you sell properties, you're deferring those taxes, you're moving all of the proceeds into your next property and not paying taxes. And you have that opportunity to do that over your lifetime. And so it can really substantially add up because each time you take that tax hit, you lose so much of the compounding that you would have had if you deferred your taxes.
Yeah, and this is a huge benefit of real estate investing. And this is something that anybody, right? You don't have to have some special status like real estate professional status. Anybody can take advantage of this benefit, and it's a great way for you to grow your wealth, but also it's a great way for you to pass on your wealth to your children as well.
Yeah, and that's because you can set it up so that at the end of your lifetime, you die, your kids get your estate, including all your rental properties, and they get a step up in basis, meaning that they don't have to pay back all those taxes you've deferred over a lifetime. And so this can really add up to a lot to be able to pass down to your heirs. And so a lot of times people will say to us, you know, should I be 1031 exchanging or should I just be selling? And that's why our answer is almost always like, yeah, 1031 exchange, right? Why would you pay taxes? Why would you slow down the build of your wealth? And why would you pass on less to your kids down the road because you didn't want a 1031 exchange? Now, one caveat here is sometimes people in our community will do what they call a lazy 1031. And so let's just define what that is because some of you may have heard about it before we go into the details of how you actually do a 1031.
Yeah, so a lazy 1031 is selling the property. You have a capital gain, but during that same year, what you do is you take that money or maybe you take other money and you buy a property, create losses. Now you do need real estate professional status or take advantage of the short-term rental tax loophole to make those losses be able to offset that capital gain from that first property. And so that's called a lazy 1031 exchange. It's not as efficient. The reason is that when you buy a property and you create losses, typically what you want that loss to do is offset your income, not offset the gain from a real estate, from a rental property that you own. And so it's not as efficient as a 1031 exchange, and ultimately that's probably why they call it a lazy 1031.
Yeah, so you may have heard of that term. We don't do 1031s that are lazy 1031s. We actually do the 1031 exchanges, but you got to do some planning. And so let's talk about a traditional 1031 and what it looks like with the rules and what you really need to be careful of to be able to make sure you do it successfully.
Yeah, so a regular 1031 exchange is also called a delayed exchange. And what you do is you sell your property, and that's called the relinquished property, and then you take all the gain and you put it into what's called the replacement property. And typically what happens is you sell one property before you buy the other. Now you can do this the other way around where you buy the replacement property first and then you sell your relinquished property. That's called a reverse 1031 exchange, but that's a very, very different process. Not as many people use that reverse 1031 exchange. Most people do the delayed 1031 exchange, which again is the typical 1031 exchange.
And the reason people don't do that reverse 1031 is you can have problems with lending, and then also it's a lot more expensive. And so that's why most of us do that delayed 1031 exchange. Now, keep in mind, it's got to be a like-kind property that you're moving out of to another one. So it's really got to be an investment property. You're not going to be able to 1031 into a primary home, for example. It's really got to be a like-kind exchange. So how do you actually do a 1031? So let's say Kenji and I identify a property that we want a 1031, we want to sell, and we want a 1031. What we oftentimes like to do is we like to go out and find a replacement property first. Because one of the keys with a 1031 is there's really a lot of limitations in the timelines, and you don't want to miss any of those rules and go over time because you will lose everything, right? And you'll end up paying taxes. So you want to be very thoughtful about watching the timelines, watching the regulations, and not going over even by hours.
Yeah, so let's talk about some of those. So in a delayed exchange, when you sell a property, you have 45 days to identify a replacement property.
Or multiple replacement properties.
That's right. And so that, now if it takes you 46 days, then you missed out, right? You've got to identify those properties within 45 days. When you're working with an intermediary, which is I'm going to come back and talk about, when you're working with an intermediary, a good one will send you that form. When it gets close to that 45 days, they get nervous too, and they start sending you forms saying, hey, you need to identify your replacement properties. Now, what is an intermediary? Well, an intermediary is somebody who handles the transaction, and they also serve as the place where the money sits until that money is used to buy that replacement property. And that money, one of the keys with a 1031 exchange, that money cannot go into your own account. It's got to go into some third-party account, and that's why these 1031 exchange intermediaries exist. And so they handle the transaction. They help you make sure that you hit that 45-day and you identify properties within that 45-day window. And then the next rule or the next deadline is you have a total of 180 days from the time you sell your relinquished property to close on that replacement property. So you have a whole 6 months. And you might think, oh, that's plenty of time. Actually, we bought a property where it took us probably about 5 months and 15 days. So we were like 15 days away from that 180 days, and it was pretty tight. But sometimes, these replacement properties, especially if you're buying larger commercial properties, these transactions can sometimes take 4, 5, 6 months. And so that's why that 180 days, sometimes you really need that amount of time.
Yeah, there are a couple points I want to make sure we clarify in there. First of all, we have some recommendations for 1031 exchange companies you can use. So we'll put that in the show notes. It's our semi-retired MD referral partner directory. Also, I want to say that because you want to maximize your tax savings, you're going to want to move all of those proceeds, and actually you want to get a bigger loan. So what that means is oftentimes if you're selling a single family home or a duplex or fourplex, you do end up going commercial. And those commercial properties, like Kenji mentioned, they take a lot longer to close. It's very normal in our community to close a residential loan in 30 days. But a commercial loan, usually it's not going to happen in less than 60 days. Sometimes it takes 90 days. And like Kenji says, you're going through due diligence, there's things you need to check out, suddenly inspection contingencies get extended, or there are other issues, and suddenly you're very easily at 4 or 5 months in. So that's part of why we want to go out and find the commercial property and put it under contract before we even put our residential properties out for sale.
Yeah, and that's really one of the keys, I think, of making sure you don't miss those deadlines. And one of the things that we see investors do all the time, and this is, I think, a really big mistake, is that they go out and they sell their property without really thinking about the replacement property, and then they're scrambling, right? They only have 45 days to identify a replacement. They're scrambling to find something, and then they just find whatever's around, and they just toss their money into this property. That's not a great deal, right? So they're kind of exchanging one property for a not so great deal because they couldn't find anything during that 45 days. So as Leti said, one of the things we love to do is we love to actually identify the replacement. And sometimes what we'll actually do is we're not even looking to sell some of our properties, but sometimes we'll find such an incredible deal that we're like, well, let's take a look at our portfolio and see which properties we'd want to sell, right? Some of them may be underperforming properties, or maybe they're not even underperforming, but they're not performing as well as some of the other ones. And so we list those properties. And like Leti said, if it's some of these smaller properties, you can usually sell them pretty quickly. And so we'll sell those. And then we also will sometimes do things like extend the closing timeline for the replacement property so that we have more time to close on that relinquished property before closing on the replacement property.
And we've also done the reverse of that, which is, hey, we know we're selling this residential property. We need to find the replacement property. We haven't yet found it. We say to the person buying the property, hey, we don't want to close in the traditional 30 days. We want to close in 60 days or 90 days. And we buy or get extra time built into that contract for closing. So now it's not just 45 days to identify the replacement property or properties. We actually have an extra, whatever we have in closing time plus an extra 30 days of closing time. And so we just give ourselves some more breathing space because, again, the worst case scenario is that you end up buying a really crappy deal because you were so desperate to get into something else, or you miss the deadlines and you don't get a replacement property and suddenly you have to pay taxes you never even anticipated.
Yeah, one cool thing we did one time was we were selling a property and we hadn't had the replacement property. We wanted to build it in a little bit more time. And so what we did was we got the buyer to agree to lease the property for 60 days, for 2 months. And that gave us an additional 2 months before we closed on that property, right? And so we got 2 months plus another 45 days. So we really extended the timeline, and that was a really cool thing. And there are lease agreements that your agent can provide for you when you are selling your property. And so this is something, it's not uncommon. I mean, it definitely is done. And that's why these lease agreements exist, for you to actually lease the property to the buyer before, so you can extend the closing timeline.
Yeah, I also wanted to talk about, doing that 45-day list. One of the things about the 45-day list is you can put more than one property on there. And so there are times where we've 1031 3 properties into buy one property. There are also times where we've sold one property and we've 1031 into multiple properties. And if you're in a situation that you're like, oh, I have 2 properties under a contract, I don't know which one I'm actually going to buy, you have the opportunity to list multiple properties in that window and say, okay, well, at least one of them is going to close. Maybe the other one doesn't work out, but I still have one of the properties in there listed as a property that I was potentially going to buy. And so I made it out of that 45-day window. I closed within 180 days. And now I still maintained my 1031 exchange, and it's still I'm not going to have to pay those taxes. Now, we wanted to take a moment to talk about who you're going to have do your 1031 exchange and some of the things you want to look for, because what's happening here is somebody's taking that money, they're holding it in a bank account for a certain amount of time, up to 6 months. And that's a lot of money that they're holding. And then you're trusting them to, then release that money and put it into the next property. So you really want to make sure you're working with somebody reputable and somebody who's really going to be on top of those timelines, because you don't want to be in the situation that they mess it up and all of a sudden, the whole thing is moot and the government's not going to recognize it, but it was because they messed up the timing or they didn't deliver when they said they would. So it's so important that you really understand who your 1031 exchange company is, that they have a really great reputation, that they're not going to run off with your money, that they're not going to miss deadlines themselves. They're all on top of it. And in fact, they're really prompting you to make those deadlines because they want to make sure that you're not going to screw up either.
Yeah, for sure. You don't want to just work with anybody, and maybe you might have some type of a local lawyer you don't even know. Again, you want to be really careful. You want to work with a company that's reputable. There's a number of companies out there. One in particular that I really wanted to highlight that we work with is a company that has a no-fee 1031 exchange. And so pretty incredible. And if you really kind of think about it, how they make their money and how they can make a no fee is that, they're holding onto your money for a period of time, right? And that can be a significant amount if they get a lot of business. And again, that's how they're able to do it. For those of you guys who are wondering, like, how are they doing that? Like, is this a scam or anything? Totally not a scam. This is totally what a lot of these companies do, is that they actually invest that money that they're holding on, and they can actually make quite a bit of money that way. And so that's why this one company is able to offer a no-fee 1031 exchange. And so we'll put the link below so you guys can take advantage of that. But I think it's a huge benefit, and also it is a reputable company as well.
Yeah, so again, when we wanted to entitle this podcast, we were like, what do we title it? Should it be when do you do a 1031 or when do you not do a 1031? Again, in our opinion and in our practice, we're always doing 1031 exchanges. It's a lot more efficient for the wealth growth. It, is a process, so you definitely have to learn it. You have to make sure you have great providers. But the amount of money that you can save in not paying taxes is just huge. And having that opportunity to pass everything to your kids and never have them pay these back taxes, also massive for the growth of your portfolio. So I think it's worth it, at least in our opinion, of going through the process, learning how to do this, being mindful about all the dates like we talked about, kind of planning ahead, not just doing this blindly, selling a property and then scrambling, but planning and saying, hey, I'm going to identify my replacement property first, or I'm going to build in extra time when I sell my property. And again, you really also have to understand the regulations about how you move that money and how much of that money, how you really need to move all of the money into the next property and have a bigger loan. So there are a little bit more regulations that we didn't go deep into. We will actually also put a blog article down below that we wrote that goes a little bit deeper. And then for you empire builders, who have gone through Zero to Freedom in our Empire Builders membership, we have a lot more content in there for you as well. So make sure you check out that 1031 content.
Now, for those of you who are really interested in the tax benefits of real estate investing, you're really going to want to learn 1031 exchanging, because one of the things that you can do when you build up equity in a property and you sell that property and scale up into a bigger property, that's going to create those bigger losses, right? As you remember, if once you take that bonus depreciation, you can't take that bonus depreciation again on the same property. You have to sell that property, buy a new property. And again, if you scale up into a bigger property, that's going to create these much bigger losses. So you're definitely going to want to, learn the skill of 1031 exchanging, knowing how to do it in a way where you don't end up, getting caught in that 45-day deadline and end up with a bad property, right? What you want to do is you want to learn how to do it really effectively by buying really good properties at every stage. And this is how you can really scale up and grow your wealth.
Yeah, and we should probably mention one more thing. In our community, a lot of people will buy properties together. So they'll do something called a tenants in common structure. And instead of doing things as a traditional partnership or JV, they'll do this tenants in commons because it allows them to 1031 in and 1031 out separately into a large multifamily property. And so if you want to learn more about that as well, we have those resources at Semi-Retired MD and Empire Builders. But that's another important one just to be aware of, is if you're saying to yourself, I have a certain amount of money that I'm going to 1031 out of, but I want to go bigger. I don't want to just go buy a 10-plex or a 20-plex. I want to go buy a 100-plex. That's the opportunity to be able to look around you and see who else have 1031 exchanges in your community, who else maybe wants to do something like a tenants in common and really go big. And you have that opportunity to do that with 1031s too. And so I thought that was really important to mention that detail. Okay, well, that was our podcast on everything 1031 exchange. If you have any questions, definitely come check out Semi-Retired MD blog. Leave us a 5-star review if this was really valuable to you, and share it with a friend. Maybe you have a friend who's investing in real estate who's thinking about 1031 exchanges. If you think this would be valuable for them, make sure to share it. We'll see you next time.